Good morning, good afternoon. Hello, hello. How's everyone doing? Hey, Sam, how are you? Okay, let's make sure that the audio and everything is working fine. You guys can hear me? Hey, Shri.
I
Thank you. Thank you for confirming. Morning, Likisha. All right, so what's up? SoFi sold my Polygon node Cardano. I don't know what is SoFi doing. They shouldn't be selling on your behalf, though. Uh,
remember you said make sure you own it, and then when they said they were going to get out of crypto about 6 months ago, I called them. I said, "What the hell's going on? Can I stick it to my own wallet?" They said no. Now I belong to, I think, SoFi threw my crypto into I forget, blockchain or something.com or something like that. So I have my own wallet.
so what is SoFi going out of a crypto?
Yeah.
Like that.
They don't do crypto any longer. So they stuck my crypto assets, which is lucky because uh oh, by the way, I'm up in my SoFi account because uh ARM has gone up.
Okay, all right. Yeah, yeah. Now I see that SoFi shut down their crypto services. Okay, so that didn't really work out for SoFi. I think they have a much bigger ambitions because they want to become a real bank. And given the
Excuse me, they are real big, but why are they be so they're charging for all the services now?
Yeah, but I think probably they have a bank charter, but I think what they currently is doing is partnering with other banks. Again, I don't know. I've not looked into SoFi. I don't own SoFi, but many of these neo banks, they basically partner with a real bank on the back end. And it's let's say if you get a card or a bank account with some other bank and not with, let's say, Chime or something else, unless they get their own banking charter and go through the whole OCC approvals and all that stuff. So I'm just guessing that SoFi, they came out of crypto so that because the regulations in US when it comes to crypto are not friendly with, with the banks. I mean, we don't have any bank which directly deals in crypto. There's one bank that have been like knocking on Fed to give them access to Fed direct account, and Fed has refused to give it to them. So if you want to be a real bank, then I guess that may be a reason why SoFi got out of crypto, because they want to now expand, basically make use of the banking charter and become a real bank rather than trying to partner with some bank and then provide banking services. That's my guess. Uh, their overall ambitions may have changed. All right, markets look great, so nothing to complain. What else happening in your life? Miss any new people? We'll get started. We'll get started. Oh, so we have a Sri Nidhi and Sri. So sorry, Sri Nidhi. Good morning. I thought that was Sri. Who else do we have? Sri Nidhi, is this your first time?
Yeah, this is my first time. I'm from Vancouver.
Oh, okay. Welcome, welcome. How did you find us? Just on Meetup or from
Yep,
some
just
reference?
on Meetup.
Got it, got it. Cool. All right. So yeah, so we meet every Saturday. We're doing it almost for 4 years now. Talk
Wow.
about general market. Investing just from a perspective of a retail do it, DIY investor.
Ah, interesting. It's nice to be here.
Good to have you. Good to have you. All right. What else before we get started? So today, at least uh, a few topics that I wanted to go through, and like I was saying, it's open for discussion if you want to talk about anything else. One is we had a FOMC meeting this week. So if you would have noticed, I've actually stopped doing macro review every week, right? Those who've been around probably recall that every week, I'll start with the macro, but I haven't done it for last 4 or 5 weeks because, over the time I realize is, yeah, it's good for info, but really doesn't make a big change in investing, right? I don't change my investing thesis based on any macro factors. Long term, it really doesn't matter. So that is why I stopped talking about macro every week. And I thought I will only come back and talk about macro stuff like interest rates and inflation only when we have a FOMC meeting. So this week we had a FOMC meeting, so I'm going to talk about macro a little bit. I'll also want to give a little insight on how some of these companies, cook their books. So Hindenburg Research, which is a short seller, they put out a report against one of, I would say, great stock called Equinix. Anyone heard of Equinix? Not the fitness company. Okay, so Equinix is a data center company, and it's of like belongs to the same family of services. Like you have a digital reality, and if you look at Equinix stock, that was like through the roof, all in. Okay, let me share my screen. Okay, share screen, and where do we go? There we go. EQIX. Yeah, and it's been a. Okay, let's go. Yeah, so I came to know about this company in 2019, 2020, related to some job offer. One of my colleagues' brother worked in this company, and they were looking to hire for a role, and he reached out to me. Unfortunately, I wasn't interested in data center company, so declined it. But that's where I came to know about this company. Looked at from investing purposes, but it was a data center REIT, and I wasn't really interested in REITs. But the stock did really good the whole of 2020 and 2021. But there's a Hindenburg research report that came out talking about how it was fraudulently they've been cooking their books. So we'll talk about that. Helps us to know, what are the games that companies play. And of course, we cannot talk about investing without talking about NVIDIA. I think that's now a rule. If you don't talk about NVIDIA, then you're really not an investor, I guess. So we'll talk about NVIDIA. NVIDIA had their GTC conference, and gosh, that looks like a rock concert nowadays, right? I don't think that even Apple WWDC, their Worldwide Developer Conference, attract so much of attention today as NVIDIA had done this week. So we'll go through a quick takeaways from NVIDIA. What else? Apple got sued by DOJ.
Vivek,
Hmm.
I did want to address Apple. I'm very angry that the Merrick Garland. I mean, he's not focusing on what needs to be done. I mean, I'm a very happy Apple user, but I don't use an iPhone. I never use an iPhone. I mean, if people don't, people buy what they want to buy.
Yeah.
He should be going after the Chinese companies. Excuse me. I love China, but they have to play by the rules. He has to go after Shein and Temu.
Yeah, so I know. I mean, we talked about how those Shein and Temu are able to circumvent the import duties, but US is going after TikTok. So I don't think we talked about it because TikTok is not public, so I didn't bring it up into discussion last week. But yeah, we'll talk about. I think DOJ sued Apple over 5. Um, I would say issues. So we'll go through it. See, does it matter? Does it not matter? I quickly looked at some of the summary. I didn't find anything which is, stands out to me. But we'll see. I think DOJ is desperate to get a win against some big tech company. So we'll see. Apple is still the biggest market cap company in the world. So. And they have been seeing some headwinds nowadays in Europe. Then not setback, but I think dialing back on their car project, spent $10 billion. Then came, and we got nothing out of that. Then as of today, the most important technology, AI, they're not developing it, or maybe temporarily not ready, and hence outsourcing it to Google. So we'll see. And now this is a DOJ investigation. That's one reason why Apple stock hasn't performed. And I was surprised to see that the market has really changed, because the Apple was down 4% and Nasdaq ended up in green. So I don't recall seeing this in the market, and I've been active in market for many years. But now the leadership is diversifying. Apple down 4%, and we still ended up green. This is the biggest company, though I think Nvidia is catching up fast with Apple. What is Nvidia right now? Nvidia is what, 2.357 trillion, and Apple is APL is 2.6, $300 billion. Not a big deal for Nvidia. It can do it in a day. So yeah, we'll see. Want to talk about that? Yeah, 8 market cap to. Oh, sorry, it's infinitemarketcap.com to come. Yeah, I've used that especially in the crypto world. Oops, because it lists. Yeah. Oh, sorry. Yeah. So the Microsoft is number 1, Apple is 2, Nvidia is just catching up fast. And where is Bitcoin? Number 10. So yeah, we'll see. And on the crypto side, we're seeing weakness on Bitcoin, Ethereum. So what's up there? Anyone has any comments or interest? Anyone worried?
Not in it. Don't care.
Don't care, don't think about it. No money in it. Right. Okay, so yeah, maybe a couple of minutes, if anyone is interested, we can spend on that as well.
Vivek,
Hmm.
you said focus on NVIDIA. Well, you're not going to earn a lot of money because the percentage gain from NVIDIA is not there. Admittedly, if I had bought an Apple rather than Qualcomm, like $10,000 worth in 2013, I'd be, I don't know, a millionaire. But I didn't, so I messed up. But what I'm saying is, if people focus on companies that are sky high, typically that's not where the opportunity is. It's finding I mean, that's what Warren Buffett typically buys.
Yeah, so I'm not advocating to buy Nvidia. All I'm saying is Nvidia has become a big company, and I actually been selling my Nvidia position. I can't justify the valuation right now, right? But I do want to go through in terms of what they talked about GTC, because SPY is market cap driven, market cap weighted index. Whether you like it or not, it does get moved if anything happens to Nvidia. Right? Yeah, so yeah, I'm not advocating that one should go and buy Nvidia here. I myself, I'm not buying it. But that doesn't mean that Nvidia can't go higher. Right? I couldn't justify me buying Tesla when it was $80, or I think $80 or $100, and it went all the way to what, 2000 before it split. But so the companies can stay overvalued way longer than we may think. We never know what's happening in the market. There's a lot of crazy stuff. And now I'm seeing the animal spirit coming back in the market. Look at Reddit. Reddit is what now, $7 billion company? RDDT. It's an 18-year-old company, right? Never made a dime of profit, not even operating profit. I mean, I did a whole review of Reddit 2 weeks ago. And so much money they are spending to enrich their management, and that company is now valued at 7 billion. A lot of folks that who had gone out of market in 2022 sat outside and now are getting the form of, gosh, I think we missed the boat. So some of these things can continue to go crazy. The idea is, guys, I'm not going to jump into this. So I don't own Reddit. I don't want to own Reddit. It just doesn't make any sense to me. But that doesn't mean that stock, it's valued at 7 billion. And I think it will continue to stay valued at least $5 billion for some time, because the CEO will, some 600,000 options will immediately vest if the company is valued at $5 billion. So I had no doubt in my mind that the company will go above $5 billion, because, it's like, you show me the incentive. I think Charlie Munger said, right? Show me the incentive and I'll tell you what the person is going to do. If the incentive for the CEO, and you can see it's in the S1 document, that more than 600,000 options will be immediately vested if in a liquidity event, Reddit is valued at $5 billion plus. So I'm sure all the bankers and the management will find every reason under the sun to tell it to retail public why it should be valued more than $5 billion. So, and then there's another one, the Trump, what's called, DWAC is now, they are de-SPACing, right? Some with Trump. This company has what, $3 million of revenue, and what, not talking about $4 or $5 billion worth of market cap. Come on. And we know why they're doing. I think Trump got hit by doesn't he has to pay a few $100 million fine, and he needs money. So now they are doing a de-SPAC. I think I do have
It's too late, Vivek. With his IPO, he has to pay now on Monday. He doesn't get his money from his IPO until 6 months. 6 months.
Yeah, so fine. I mean, he can buy a loan if the banker see that he got a windfall coming in. So they'll probably give him a bridge loan or something. So all I'm saying is that the craziness is back in the market. Yeah, meme stocks, meme cryptos, everywhere. So, and this always, when the numbers go high, when the market continues to go high, it attracts a lot of crowd from outside who think, we're going to make a killing. And then we ended up making decisions that we regret. So when I'm not saying that the market is on top, it could go to 5, what SPY is now 525. Now latest estimates, okay, 520. Latest estimates I'm hearing is like 540. I think it's from Bank of America or someone, that 540 is their new target for the year. So it could continue to go high, but I think we have to be specific in terms of which companies we pick up, because just like in 2021, there will be a lot of crap companies that will now come public, because the IPO market is now opening up, and the companies that have been waiting on the sidelines because the market was closed, no one was willing to invest, will now find an opportunity to come back to the market and offload their shares. So I'll not be surprised if we see many companies with no revenue coming to IPO. But good thing is that there are other companies which have a real business making real money will also come to IPO. Like companies that I've been waiting for is, let's say, Databricks, Stripe. I'm not sure what valuation will they come for IPO, but at least now if the window is open, we could see some of those companies, taking basically taking this opportunity to come and come to IPO, because all of them have been raising over the last 2 years, have been raising money from private investors or VCs doing next round of financing because the stock public market was closed. DWC dropped a lot on announcement. They have the internal lawsuits between investors. Yeah, I mean, I haven't been following this one, but I wouldn't be surprised because now they are doing going through the whole D-SPAC process so that DJT can, get a hand on that money. And I didn't look at what the details are. But yeah, we got to be careful. So those meme stocks may be back in the market. A lot of juicy option premium. I bet. What's the volatility on this one? Oh my God. 300. Okay, so looking at a May or 345% vol. Of course, you'll get all this juicy premium. But that's because there's too much of a risk anyway. All right, so let's get into today's session. Guys, welcome to session 211 of our weekly discussion. Before I jump into this, I think I can do one session on Wednesday in the middle of a week. That's a day when I don't have to do my parental Uber duty in evening. So I was just thinking about, and I'm asking you guys if there is an appetite for it to maybe do a session just for very beginners, because I did receive a couple of emails talking about, hey, I'm a noob. I've never invested in market. I don't know anything about a stock. Do you talk for the beginners in this Saturday session? And as you guys know, in Saturday session, we cover everything, right? And some of the things may be too esoteric for someone who is just a beginner. So I was thinking maybe just a noob session on Wednesdays. Anyone interested in noob session on Wednesday? Which is beginners for option or beginners on the stock. Wherein, like, hey, I'm not investing in stock. And before investing in stock, there are a few things that we do, right? How is the rest of the portfolio looking like? Or what are the other loans that you may have? Where's your emergency fund and all that? I've covered these things on and off in Saturday session, but now because the markets are high, a lot of new folks are coming in, and I think it's time that we should tread carefully, not jump into it immediately. Okay. All right. So let me plan for something, not this Wednesday, but maybe from next Wednesday. We'll do a basics session, basics stocks, basics options. In fact, yesterday I was looking at someone on a Twitter, like with 50K followers, and trying to explain call spread. I'm like, gosh, you are doing it the wrong way. And I'm imagining the people who are following him. Gosh, because now, everyone wants to learn options now because the markets are hot. Right. So, and as you guys know, I attend a crypto meetup on Tuesdays, and I found someone who's actually paying to learn about options. I'm like, no, don't do that. There's a lot of free resources available. If you're paying to learn options, that person probably is not making money by trading options. They're making by probably selling the course, right? Just like in 2021. Right. I couldn't have gone through in 2021 any YouTube video without getting ads from options, right? The best option traders. Anyone remember Jeff Bishop, Jason Burns? So what happened to them? They all got sued by FTC because they never made any money doing options. And now they've disappeared. So every bull season, you will see some experts on YouTube, and when the bear season comes, they all just disappear. So anyway, so let's keep.
So Vivek, I've been watching your bootcamp videos that you did it like 2 years ago, 3 years ago,
Yeah.
and it's really, really good. So I would recommend whoever wants to learn that. It's very informative.
And on Tuesday, when I came to know about someone who was like paying for learning options, I just opened up the bootcamp. Now, if you just go, let me just give you a link. You won't even have to register on the website. So where is the bootcamp?
So
Because I just don't want people to burn their. Sorry.
So originally you said there are gonna be 14 session, or but then there is only 13. So I think the last session is missing there, which
Yes, it's missed. Last session is, I think, related to the strategy discussed, but it was not published. I
Yeah,
also
so I
heard the
think
same.
so I think maybe the reason I actually forgot to record on that session.
I see.
No, now you remind me. Now I remember the last one I forgot to record while I was doing that.
I see.
So I think
Okay.
that's why you have only 13. And I guess the last one was, and it's been 3 years because that I got busy with other work. The last one was just related to maybe Q&A or something like that. I can't even recall.
Yeah, it says
No, it's like
related.
advisory, what
Yeah.
to invest and all things, summarizing everything. That's what it's very important session, I guess.
And how to manage it, right? While working full time, like how you have done it in past. I think that's what
Okay.
it says in the title.
Yeah, so maybe I'll go because this was, I think, my 3rd time I did it. Maybe let me find out if I can find some old video, maybe the first session, etc., where I actually covered that one. And then I'll put it there. But I remember I forgot to record the last one.
Okay.
Okay, so
And
let
before
me,
watching your bootcamp, I was about to pay somebody to watch the option, and then I've been attending your session for a couple of weeks now, and I saw that bootcamp is over there, and I looked it up, and I'm so glad that I didn't spend any money.
yeah, so here's the link. I'm sharing the link for bootcamp. Now, if you click on this, you should be able to access it directly. I mean, earlier you had to just register it. Again, it was available for free, but you had to register it. This week I will remove that friction because I realized, oh gosh, people are getting scammed by paying for option courses. So anyone, just click on this and tell me if you're able to access it. Okay. All right. Yeah. So this has got a series of now 13 videos where we talk from very basics all the way to how to manage a portfolio using options.
Excuse me, but why do I see only 5 videos in this link?
There'll be you'll have to click at the bottom to go to the next one, next page.
Okay. Okay, I'll check it out.
So you will see next right here. Cool.
Yeah. Thank you for sharing this.
All right. Okay, so let's get into today's session. And on Wednesdays, we'll do a noob sessions. So if anyone have a very basic questions, we can go through those on Wednesdays also. Not that if you have a question, ask here as well. All right, so let's get into today's session. Let's talk about a little bit of a macro first. So we had a FOMC meeting, and I think the market really liked the message coming from Fed, and the overarching message was that the rate cuts will be happening, right? And if Jerome Powell also confirmed that the dot plot from a Fed is still pointing to 3 rate cuts. I think earlier market was little jittery, saying maybe instead of a 3, they're gonna do only 2. But looking at the dot plot, that's the greatest piece of technology on which trillions of dollars are running is the dot plot. That's still pointing to 3 rate cuts and no change in the current rates. It's still going to be 5.25 to 5.5%, but we're going to have a 3 rate cuts in 2024. Gradually, we're looking at by 2026, the rate cut could be 3.1. But what I found interesting is that long term it's going to be 2.6%. That means 2% is no longer the target. That means we're not going to go back to 0% interest rates. The 0% interest rates that market and as a consumer we became used to for 15 years. We're not going to go back there. And Fed is okay to keep a long-term interest rate close to 2%, 2.6%. What does that mean for the other businesses? Businesses will have to adapt that now they cannot raise money at funds at 0%. There is a real cost to the funds now. So, but I guess this is what the normal scenario is, because whatever happened in the last 15 years was not normal. The incessant liquidity provided by Fed, 0% interest rate, wherein you have no risk to borrow, that was not normal. Now we are reverting back to the normal way of doing business, wherein if you borrow money, there is some implication. Right?
Vivek,
Go ahead.
do you think it has to do with China bought a lot of U.S. Treasury bonds from 1998 to 2018? Do you think that has anything to do with it? Because the China buying the treasuries kept the interest rate low, so they were financing their own exports to the modernization. So do you think that has anything to do with it? China buying the U.S. treasuries in so much bulk.
Yeah. So I know China has been selling US treasuries, but I think the overall the point that you're hinting towards is that the demand for US treasuries is coming down, and could that be a reason why the rates may stay higher? I don't know if those two, I can correlate those two. Maybe, but I'm not sure. But I guess what I like is that now there's a real implication of borrowing money from the market. Earlier, there was not real implication. Here you could borrow and do whatever you wanted to do. So we saw a lot of those excesses in many companies. Now there is a fund that the companies or the CEOs who are good captains of business will be differentiated from the ones who are not. No more zombie companies. Right? The companies who have a real businesses will grow. The companies who don't have a businesses will die, because now you can't borrow at 0%. So now the good and the bad will be separated. So those who actually are, I guess maybe if this is going to be the case, then the stock pickers will have a good time in investing, because now those who know how to pick good businesses will benefit. Then hey, let's get the whole basket here. Anyway, so that's one is we're not going to go back to zero, at least as of Wednesday. That's what the Fed says. Economy seems to be doing okay, right? Not bad. So we are basically there's a comparison between what we thought we'll do in December and what's the change in March. The recent FOMC meeting is 2024. Earlier projection was that the GDP will grow at 1.4%. Now we are saying GDP will grow at 2.1%. Right? So economy seems to be doing better than what we thought, or the projections for the GDP growth is better than what was thought earlier. 2.1 2024, 2% 2025, 2% 2026. I don't know. We'll get to know how these pan out, but this is as of right now. Paul also noted during the conference that the economy is strong, labor market is strong, and inflation has come way down. We generally don't get these three things together, right? If the labor market is strong, And we see generally inflation going higher because people have more money. They are not they're willing to spend higher price. So, but compared to where the inflation was earlier, yeah, it is now coming down. Third thing is balance sheet tapering. This is where the Fed will not buy more assets onto the balance sheets or won't renew it. Fed will slow down the pace of its balance sheet reduction. So this also means more liquidity in the market, right? So balance sheet has come down from 9 trillion to 7.5 trillion. I feel it is still higher, but what do I care? This is the election year also. So Fed is not gonna continue, they're not gonna continue the balance sheet reduction at the same pace. They're gonna slow it down. When they're gonna slow it down, we don't know. But all these three things, right? Rate cuts, 3 rate cuts in 2024, good, strong economy, balance sheet reductions, all points to the fact that this is going to be liquidity in the market. When you're cutting down the interest rates, you're gonna make the financial assets basically more attractive, right? You run your valuation model, your risk-free rate is coming down, so that boosts up your returns on your risky asset like stocks and any other investable assets. Good for investing. Economy is strong, GDP growing, companies will continue to grow, good earnings growth, good for investing. Balance sheet tapering means more liquidity available to the banks to lend out as a loan. We should see growth in consumer loans and all that. Net injecting liquidity in the market, good for the stock market. So looking at all these three, and I know stock market is what, 520. I think it all still points to the bullish sentiment in the market. Now, that doesn't mean it's gonna continue, just in one direction. Of course, market will go up and down. That's how the market does. But looking at what FOMC was, the Fed is pointing out to be, to me, it still looks like there's a lot of fuel still being injected into the market. I'm being cautious, but I'm aware of the fact that, guys, the market can continue to go higher, when this happens. So I'm not going out of market or selling, saying, oh gosh, we already hit a new all-time. We actually hit a new all-time high this week. Right? But that doesn't mean that it won't go higher. So I'm staying invested. I'm not making any change in my, how you manage your portfolio. Just that, when the markets are, or when some of these individual stocks are so high, I want to be a little cautious. It is not just the Fed. I think other central banks are doing the same thing. Everyone is now talking about reducing the rates, except Bank of Japan. But Bank of Japan has always been a little weird. So they're going to increase the rates from negative 0.1% to 0% to 0.1%. So they were on a negative interest rates. So that's on the macro side. Other thing is, because the markets are already so high, some portions of the market have become very expensive. Right? I got a chart from Barron's. We're talking about companies like NVIDIA. Now it has become even more expensive, trading at 35 PE of 2024. Cadence Designs, Eli Lilly, again NVIDIA, Cadence, they all going through that whole AI wave. Eli Lilly going through your weight loss drug wave. Intuitive Surgical, I didn't realize Intuitive Surgical is like trading at 62 times or 17 times price to sales. And Visa. There are other companies like ARM Holdings, Wingstop, Snowflake. And Snowflake, I think after earnings, probably now it has become cheaper. No, I guess 167 is still over there, and still it is very expensive. Costco. One of Charlie Munger's favorite stock, Costco. Why would I want to pay 48 times earnings for a company that sells consumer staples? But right now, everything is going high. So if you really want, that's what I think. There are some sections of the market which are cheaper, but there are some sections which are very expensive, and some of those very expensive companies have bigger market caps, which is driving all the stocks, basically the whole S&P higher. Ross says Fed is injecting liquidity into the market in sneaky ways. No wonder SPX is flying since November 23. Yeah. NVIDIA P doesn't look very expensive relatively. True. Yeah, relatively it is like 35. Right? But S&P P is trading at what, 26? Which is because a lot of it is also driven by NVIDIA. On an average, S&P trades at 15, 16 PE. So S&P itself is trading higher and largely driven by companies like, some of these big companies like NVIDIA with 35. And these are all PE, estimated PE, right? This is not your, these are, I guess, is a forward PE. If you look at NVIDIA current PE, that should be much higher. That is like 79. So all this is based on our expectations of what the 2024 earnings would be. And when I don't think it's the first time and again, we have seen that when we get these new waves of some new tech analysts as well as the companies, they both, we just expand the market. We just think that there is no end to how big the markets could be. We've seen that with Tesla. We've seen that with during internet. Now we are seeing this with NVIDIA. But we'll see. If NVIDIA continues to deliver, yeah, it's pretty cheap right now. But not pretty cheap, but as compared to some of the others, it is still cheaper, like 31 PE. Costco should be a long-term investment. Yeah, but not at this price point. Guys, pricing will matter. So you buy Costco at what, 50 PE? And let's say when the multiples start to contract, because they will contract, it won't stay at the same multiple as, forever. And what's the Costco's long-term multiple? Costco is CUSD, Costco, right? Let's look at the ratios. Where's the PE? PE is here. There we go, PE. Let's say mid-30s. Costco, PE. Yeah, it's never been cheaper, but it's like, mid-30s. Right now it's trading at 50s. Even if just it goes back to the lower multiple, the stock is looking at 25-30% downside just from a multiple compression. So that's what I'm a little worried about. Is Costco is a great company. It could continue to increase the revenue. I'm not saying that the revenue won't increase. It may continue to increase the revenue. So they've been growing what? In fact, in 2023, their revenue growth was less. It grew only at 6%. So even if it continues to increase the revenue, I'm only worried about the multiple compression, because right now it's a lot of the stock growth in the stock is coming from a multiple compression, because the net income has grown only 7%. Right? EPS has grown only 7%. Whereas the stock Does it have a market cap growth? Let me see if it has a market cap growth. Stock has grown from 241 to 325, right? It's almost what 25%?
Hey, Vivek, shopping at Costco right now. So shopping is good.
Shopping is good. I mean, I shop at Costco. Today I have to go to Costco. Morning, my wife was saying refrigerator is empty. I said, I have a plan. I'll go to Costco today. So, so revenue will continue to grow. I'm only talking about the stock. Stock looks pretty expensive right now. To me. So a good place to shop, but stock look expensive. Yeah. So that's in Costco. I mean, we got to be a little careful on the companies that we're picking right now. MRK PE is too high. I thought it should go down, but it is holding. What is MRK? MRK. Merck. Forward P 12.69. Current P is, so maybe I think I haven't looked at, I mean, I've never invested in Merck. So maybe for this particular quarter, they may have something that has impacted their net income. Just looking at quarterly basis. So they actually, for this quarter, they actually were negative. Looks like that's never happened, at least for last many quarters. So I'm looking at, yeah, something. So if you're looking at Merck, something happened in this Q4 wherein they actually lost money. Sorry, not, yeah, there we go. They did in 2023. Yeah, so they let's go look at the annual one then. They'll give us a better one. Only 365 million annual income, which is like way less than some of the other years. So what could have happened? So let's look at, when you're looking at this company, that's how I'll look at. Okay, the revenue is 60, no change in the revenue. It's not that the revenue had declined. Gross profit is still the same, right? Similar gross profit, so nothing has changed. Something has changed on their operating expense side. If you look at the biggest one is R&D and operating expenses. These two have almost more than doubled in this year. Now you'll have to go and see why it has happened. Of course, this does not have the detail, but if you look into their quarterly or yearly annual filing, you'll get to know which portions have contributed so much for this operating, overall operating expenses. Like R&D is up like 30 from 13 billion to 30 billion. That has bumped up their operating expenses from 23 billion to 41 billion. And that has now gone down their income statement and have bumped up the price. So now if I look at, so let's look at Merck, MERCK, investor relationship. Okay, we are digressing, but I think this is a good exercise. This is how, for now, let me. Financials, annual report. What has changed that caused financial statements? Where are the notes? Or we should find it in management discussion. Hold on. Oops. There we go. Let's the total sales is this. Okay, they talk about vaccines, cardiovascular, where they talk about Keytruda's, all these approvals. Somewhere going through this, they will talk about in terms of what contributed to increase in their R&D expense, because that is the biggest expense that they had, and that has brought down their current PE. So is it could be a one-time expense? If it is a one-time expense, then probably I won't be worried about it. But if it is something that is could continue, that will be a problem. So let me just say, is it happened because they had too many people, company business into new products, blah, blah, blah. Approximately 21,800 people were there. I don't know how much were in 2022. If you go back and if they haven't hired too many people, then probably it may be due to some one-time expenses. And again, I've never followed Merck, so I don't know what's happening over here. But that's the case. That's what I'll try to find is what happened to the R&D. Is it one time or is it something that has do they report they adjusted? Let's say if anywhere they say adjusted will be in their earnings announcement. Full year, let's to full year. GAAP EPS. Okay, GAAP EPS include charges of $6.21 per share for certain business development transactions. Full year GAAP EPS of 0.14. Non-GAAP EPS was 1.51. GAAP and non-GAAP include some charges. Okay, so there is something which is they claim as one time, because in absence of that, your EPS would have been 1.51. But right now the EPS is like 0.14, which means there is some one-time expense that has caused this EPS to be almost 80% lower than what it would have been. So it means then I won't look at just the current PE. So if PE is showing about 900, I think it can continue to stay at 900 because that expense may be just one-time expense. So that's all. That's all. Look at it, and if I have more time, I'll just go through that whole earnings to see what that one-time expense was, and is it a real one-time expense? Okay, what about PFE?
If Pfizer, I'm holding in a retirement account, and I think about around 40 something, and it's like 26, 27 and change, and not sure it's holding on. Should I get rid of that?
Yeah, so I mean, again, I don't own this. I don't haven't looked at it, but Pfizer enjoyed all the tailwinds from COVID.
Yeah.
And that tailwind has gone. So all you need to look at is what is the next, pipeline. Because all these pharma companies are heavily dependent on their pipeline of, new drugs. Where are they in terms of stage of approval and all that stuff?
Gotcha. Thank you, Vivek.
What's the preferred PE ratio to invest in a company? I don't have any such preference because it depends on what stage the company is in. So if it's a mature company, let me start with, if it's a startup company, not startup because it's not public, but let's say if it is a company that has recently become public, but don't have, just building their product portfolio right now, I won't even look at PE because probably they are just losing money right now. Right? Their intention is not to even to make any earnings. So I won't even look at PE. At that point of time, I'll just look at, gosh, are they growing their revenue or not? If they're
How
not
about
growing their revenue, then I am
how
not.
about companies like Reddit never made any money?
Sorry? Company like?
Social media company like Reddit never made any money, right?
Yeah. Yeah. But Reddit like 18-year-old. Right.
Gotcha. Yeah. Mhm.
So the 18-year-old, then I'll get a little worried. But if it's a new company, coming to the market, and when I say making money means not really net income, but that is operating income.
Gotcha.
Net income, you can always do accounting gimmicks to boost up
Mhm.
your net income. I want to look at operating income. So if it's a company that still focus is to grow the business, I won't even look at PE.
Mhm.
If the company is moving, then I want to look at a revenue growth.
Gotcha.
If the
But
company has already established the products in the
Yeah.
market and now started to get more and more customers, then I'll start to look at your operating income. Are you making
Got it.
operating income or not? Because if you're not
But
making operating income, then you're dependent on the largesse of others, right? You're dependent on how good your VCs are, or how good the public market is, or how cheap the loans are available, because you're not making any income out of your operations.
Mhm.
In that case, I want to at least make sure, okay, you're at least generating some operating income. If a company has products, they are making good sales, then I want to look at their maybe your price to gross profit ratio, but not really PE. Now, when the company starts to move into a phase wherein their focus is to start making net profits because they are well established in their markets, then I'll start to look at PE. So Costco, I will look at PE. Palantir, I will not look at PE. So that's the difference. You need to understand where the company is in its stage of company's life cycle. Every company goes through the phase of their startup phase, their growth phase, then their maturity phase, then they plateau, and then they start to decline. And if the company is in a phase wherein they are plateaued or in decline phase, I'll see, okay, how are they returning money back to me? What's the dividend yield? Then I'm not going to look at the PE because, hey, it may be available very cheaply as a PE because there's no growth left in it. So then start to look at, are they buying back shares or not? Or are they returning the cash flow back to the investor as a dividend or not? So depending on the stage of the company, the different metrics will apply. So I don't have any answer to say what's my preferred PE ratio.
Thank you. This helped. Thank you.
It is important to understand the company. I mean, these are not just the tickers that I see or we see on a trading platform. There are real businesses behind it, and you just spend some time to understand the business. Ross says may depend on value or growth stock. PEG is a better to scan. Yeah, PEG basically says PE adjusted for the growth. Yeah, PE doesn't matter for growth stocks. Operating income should be best for startups, right? So, it's a no. So yes or no. In case the interest rates are lower, or the market is little ebullient, not let's say euphoric, or market is bullish, the company can still have a negative operating income because they can go and either raise from the market, issue more shares or raise debt. But it isn't, but if the market is kind of closed from a new financing, that's where everyone will start to look at, gosh, are you having operating income or not? So I do want to focus on operating income once the company becomes a little bigger, because are you making operating income or not? If not, then is there any other way you can raise finances? If the market is conducive to raise finances, then I'll be okay. In 2022 and in 2022, 2023, suddenly every VC realized that none of the startups companies were making any operating income. And then they started to go back and tell each one of their portfolio company, tighten the belt. So you can't raise money from market. VCs didn't have, no one have funds. Public market was not open. So if what I used to say from operating, I used to say is, it's like if you're not making operating income, you're dependent on a ventilator. You're not breathing on your own. As long as ventilator is available, you have a bed, you live. You only start to feel the pain of being operating negative is when the ventilator is taken away from you. So, and that's what many companies felt in 2022. Yeah, Shri you have your hand. Yeah, go ahead, Shri.
Yeah, I'm looking at the Finviz and for MRK, and I see the insider trading. It says Merck and Company Incorporation, 10% owner, buy transaction cost 23, and the number of shares value. Is the cost, is this the purchase price, or is this the average cost of the entire shares that the Merck Company owns? And Merck Company is the buyer. Why does Merck Company buy it?
That is interesting. March 11 did they bought back their shares?
Well, they would have called it as buyback or something of that
Yeah,
nature.
so Finviz may be reporting with something else.
And it says 10%.
No, it says a 10% owner means they have more than Merck.
They own all the shares.
Buyback.
But they did not buy it at $23.
Yeah, I don't know. Is it a Finviz issue or is there a filing behind it? SEC form. Oh, so issuer name Harpoon Therapeutics. Did they do some acquisition or something? Or did they bought this securities acquired 21 million? So there's something between Harpoon Therapeutics and Merck. Some transaction has happened at this pricing. This was not a market pricing. So let's see, Merck, Harpoon. Merck buys Harpoon. So it was through a subsidiary. Yeah, so actually they bought Harpoon shares, and I don't know how the deal is structured, but looks like it's a transaction because of the acquisition.
And so they got it at $23 per share of the Harpoon.
I don't know how this would have been structured. So it looks like they paid $680 million for this.
Okay.
And they
Thanks.
might have issued, yeah, so they issued, there we go. This makes it clear. So they bought for 680 million, and they offered 23 per share in cash to Harpoon, and maybe the other stuff was paid in
Is that only for 10% of the
shares of
Harpoon
Harpoon?
company?
So it was like 100% cash. I don't know if it was a cash plus stock deal, but that's what it looks like 23 is coming from. They paid $23 to per share to buy this company.
Okay.
Okay.
Sorry to take you away from your thoughts.
All right. Yeah, P. Shank said when large company buy a small one, the stock or large usually falls because they think that they are paying too much for this company. But yeah, this is not the case. I think this is because And I don't know how the reporting happens in case if you are paying or buying another company in cash. So why it says $23? Or was like only 492 million was paid in cash, or what happened? So I don't know how it gets reported in SEC. I'm not an SEC guy or a lawyer, but it looks like share acquired $23 and total 21 million amount. Okay, coming back to where we were talking about stocks. Some of the stocks are very expensive. So the question is, could there be a case for equal weighted S&P in which even the companies that are not big get an equal amount of weight as NVIDIA will get? Today, companies like NVIDIA, Eli Lilly, which are now already so big, are dragging the index higher. But if you look at an equal weighted S&P, in which NVIDIA and Eli Lilly, they don't get special treatment, they don't get higher weightage just because they are big. This is one interesting chart of equal weight minus market cap weight, which is SPY, 250-day rolling returns from 2004 till now. So this shows that the rest of the S&P, right, except the big ones, many of the others, they haven't performed yet. The difference between the equal weight and the market cap weight is like 3 standard deviation away since 2004. So that means if all this says is that some of these the big market cap stocks have been driving majority of the returns till now, since what, October, I would say whole of 2023 and even now. Now we may see some of other stocks, catching up to it. If that's the case, especially if the rates are coming down, which will be good for smaller companies. Bigger companies, they don't need to raise money from market anyway, but it's all the small, the companies like which are in your Russell 2000 companies, small and medium businesses who basically generally raise money from the market. Now, if the rates are coming down, they will be able to refinance those loans at a lower base, which will, bode well for them. If that's the case, we should start to see more broadening of the market. Last 2-3 weeks, we actually started to see broadening of the market anyway. So there's a case of maybe equal weighted S&P should now start to do better because this has gone too far. It's like almost 3 standard deviation away since 2004. Something for you to think about. Sector-wise, S&P is up like almost 10%. What more can you ask for, guys? And surprisingly, real estate is the only sector which is negative. I didn't realize that. I'm seeing it now. Communications up 15% and real estate is negative 2.3%. What's happening on the real? I guess that may have to do with a lot of a commercial real estate, because we know commercial real estate is tough. Now banks are going under because they had a lot of commercial real estate loans. So I guess it's related to that. And yeah, tough year for real estate. So other chart, looking at a emerging market. And this is where I got beaten. Like I've been beaten up because I'm always want to diversify, saying, okay, US is super expensive, let's look at emerging markets. EEM is my favorite ticker, and then you have a country specific tickers, right? INDA for India, EWJ for Japan. I've traded in EWW, EWZ, and 10-year, if you look at average annual return, like S&P is up 12%, emerging market is 3%. That really hasn't worked out. Every time when the market is all-time high, I think, oh gosh, we need to, go beyond US and look at other emerging markets. And US still continues to perform. Right. So looking at 10-year result, 12% from S&P, and overall emerging markets, which is EM, is only 3%. Of course, I think there are some components that have done equally well. Taiwan was 11%, India is 10%. Other than that, China hasn't done anything. Because I think last 2 years, whole China ETF have done nothing but just go down. So that has, I guess, screwed up the whole 10-year return on China. So China, you can look at FXI is a large cap China ETF.
Excuse me.
It's been ugly shape.
Did you ever live under a dictatorship?
No, I was lucky enough not to be.
I thought all the Chinese leaders I lived under is a dictator. Well, I just call them authoritarian police state, but I think Xi is rather than helping the masses, he helped the masses by helping the commercial markets. He's really screwed up China for the past 4 years, 5 years. But then on the other hand, U.S. has been screwed up for 20 years, and maybe even during Clinton's era. I mean, because Bush Jr. gave away. You know what I mean? Is that they're going through a difficult time because the ruler leadership is not right.
Yeah, so I know right now China has been going through a tough time. If you look at this and this is a monthly chart, 2005 to 2010, and of course there we have a GFR. And now if you look at it, it hasn't been, I mean, the China economy has been growing, but all the stock market, if FXI is like between 55 and never made above 55. So whereas except the first 10 years, like 2008, that was the peak. Beyond that, I thought maybe the Chinese stock market was actually had done much better, because I only started looking at FXI in 2018, 2019. So yeah, so it hasn't done much anyway. And over the last 2 years, it's gone even worse because of the property market. So from 50 is all the way like cut into half. So 10 years looks like it's only 1%. I'm like, oh, you don't have to go out. Anyway, this is just from a diversification perspective. I still hold EEM. I don't have any FXI though. I still hold EEM and I do hold India. So a quick look at the emerging ones. Fear and greed index still in greed area. So time to be cautious. What did I buy or sell? This week I bought, added a little bit to my Adyen position. Coupang, Apple, and FBTC. I didn't sell anything. And again, these are not the recommendations. That's not what you should go and buy or this, but I do share because I talk about these stocks, right? This week, and again, just from learning perspective, I added one more category saying what I got SARD on. So there's a company called StoneCo. Anyone heard of StoneCo? Berkshire Hathaway had invested in it. Anyone own StoneCo? Yeah, this is a good example of why you should not outsource your analysis to anyone, even if it is for Berkshire Hathaway. So I invested in StoneCo in 2021, when we had a lot of this fintechs company. Because of COVID, all the fintechs companies was going higher. And I, of course, had exposure in US. I was looking to get exposure outside US and realized Berkshire has bought a company, they had invested in a company called StoneCo. So I bought in StoneCo, but I never increased my position because I didn't put in my homework. But, I kept it. sold calls to reduce a cost basis a little bit. But this week, I'm like, let me just study this company because I didn't have my investment thesis document created for StoneCo yet. And I went and looked at the last year annual report. And what I saw, I'm like, what the heck? I just couldn't understand how this company is structured. I didn't have any issues in the, I mean, the business can go up and down depending on how the market is, but the whole structure and the way company diversified into a completely new business and how the company is structured, I'm like, okay, you know what? This is not for me. So a few highlights I want, if in case any one of you own it, a few highlights. It was a payment services company, just like PayPal, payment processor. And in 2021, it moved into software development by acquiring a company called Links. This I'm aware of because I heard about it. But what I didn't follow up was not just one company. They did another bolt-on acquisitions by buying stakes in 10 plus companies. Who does that? Right? And then I realized it is actually registered in Cayman Islands instead of Brazil. So that was how is your corporate structure? And then when I look at the corporate structure, I find out they got a venture arm, which is buying a stake in smaller company. And then they got in Cayman Island, and there's some dealing between the venture arm and the fintech company. I'm like, okay, you know what? This is too hard from a corporate governance or structure perspective. And then when I started looking into their margins, I was like, the margins of the software business is very, very low. So I'm like, this is not really a software business, more of a consulting business, right? And like I said, the structure is so convoluted with multiple subsidiaries created for different purposes. And then I realized that they got a new CEO. I'm not a new CEO, he was in the company, but he's never been a CEO of a software company. Pedro Zinner, he coming from an energy company. So I was about to, I thought I should sell all my shares. But then I looked at the letter to shareholder, and then I realized the CEO is talking about making some changes and saying we need to change the focus of the company. I thought, okay, now you're talking because what are you doing by buying 10, 15 companies? Become more operational, profitable, and allocate the capital better. So I decided not to sell, but after a long time, I realized the stock, I'm like, why the heck is this happening here? But I became more aggressive in selling covered calls. So I have a covered calls like at the money, $1 away, $1 away, $1 away. If it gets called away, I have no regrets because like I really don't, I mean, I have my own doubts in terms of how this company is structured and what are they doing in Cayman Islands and all that stuff. So I haven't seen the 2023 annual report is not out yet. So I have to see it and see if anything has changed. But Citigroup, I've upgraded the target price to 20. So maybe I'm completely wrong. So we'll see. But I thought this is a good lesson in how you should not outsource even to Berkshire Hathaway. I don't know why did Berkshire Hathaway buy this? This is very unlike Warren Buffett type of company, which has got tons and tons of subsidiary in Cayman Islands and buying software companies, and I don't know how they have all structured this. So that's on StoneCo. StoneCo was IBD favorite, maybe because Berkshire had invested in it. So let's say Berkshire StoneCo. I only heard this name because, these buggers, they sold out. I mean, I invested in because Berkshire was in it, so I didn't do my homework. Okay. All right. So maybe, so then maybe I'm on a right path. Who knows? I mean, this all is okay. I just didn't like their whole software part, and there are like 10, 12 subsidiaries. So anyway, so I sold this and oh, sorry, I didn't sell it. I just became very aggressive in selling covered call, and some of the money that I received from that covered call I put in Adyen. So that's why I bought Adyen. All right. Sold at a loss? No, I didn't sell. But I have a covered calls on it. If it goes at a loss, that's fine too. Okay, this is the Guru's trade for StoneCo. So almost everyone has sold out. Everyone has reduced. Gosh, I'm the last one, huh? But I'm glad that okay, the analysis. Let's look at the stock and I'll say financials for STNE. The financials probably may be okay. So yeah, so they grew their revenue 25%. No, with $5 billion of operating income. Oh, sorry, this is not billion, this is Brazilian real. So from that perspective, like 49% operating margin, 13% profit margin. But what I had two major concerns. One is the whole corporate structure. The other one is the software business that they've been buying like 10, 12 companies. The margins are pathetic. So those were my two major concerns that I had. So I thought I'll bring it up. Maybe if there's more interest, let me just see if I did any more. No, that's the only thing I noted. Yeah, I hadn't done much of the homework on StoneCo. And that's where then you realize, oh, if you don't do the homework, this is what happens. This is not the annual report. So hold on, let me just bring up, is this the annual report? You see, these are all the companies that they have bought, either 100% or some holdings in it. So yeah, it's a difficult pie for me to understand. And I'm like, okay, there are better opportunities. All right. What else? We had a settlement of National Association of Realtors. Nothing investable discussion over here, but just that we will be, I mean, just want to see what you have any thoughts around it now that the sellers will not have to pay for buyer's agent. I mean, in the media, there are different thoughts. This thing it's really bad because why should a buyer, why would buyer will have to pay? My own analysis was the buyer was always paying, not directly, but indirectly. Right? Seller will always account that brokerage that he has to pay. And eventually it was going from buyer's pocket because buyer is the one who is giving money. So whether directly or indirectly. But now buyers are free to negotiate and get their own agent, what the fee they want to pay with their agent, and the seller doesn't have to pay the buyer agent. So overall, the 6% fee that sellers had to pay is now completely negotiable. Some say that it's going to bring down the overall cost of transaction, which is great, but it's going to be really bad for a lot of real estate agents. So if you are invested in any real estate agent companies like Zillow, Redfin, I don't know that Compass, is that a publicly traded company? They may see some tailwinds because of now the commissions being reduced. Any real estate agent here in the group, in the meeting, who can talk more about it? Okay, so I'm from my perspective, I'm like in the US, probably there's a practice that is a seller agent pays to the buyer's agent, and hence there was so much of I guess little noise around, oh gosh, why are we doing this? If a buyer will have to pay, and then they'll be less inclined to buy the homes, and then the home prices will decline and whatnot. Like as other countries, I mean, I bought a home in India. It's always like buyer gets his own agent, seller get their own agent. And when I bought something in US, and I'm like, what? I don't have to pay anything to agent? What do you mean? So for me, it wasn't a big surprise because we've done transactions. I mean, it's a norm. In India, everyone get their own, seller get their own agent, buyer get their own agent. Looks like now we're gonna do the same stuff here. It's both the parties get their own agent, and then who will negotiate? So there might be a headwind on Zillows and Redfins if you own any of those real estate agent kind of a stocks.
Excuse me, doesn't the real estate agent have some liability for because for some stuff that goes wrong with the house, that they're supposed to know some legal liability? I mean, that's why if I buy a house, I would, just pay whatever is needed.
So legal liability will be if you're able to prove that he has a malintent or he didn't do his job. He will go through the documents and will tell you, okay, these are the things that as per the documents, the disclosures. If it is not in a disclosure, then it doesn't reliably. Even if it is not in disclosure, then you'll have to go and sue the seller saying you didn't disclose me this. But when it's a seller market, who cares? But anyway, I think, in my opinion, this is good that it's going to be a competitive market, but because that for decades and maybe for a century, it's always been seller paying it. So I think US market will go through normalization process where everyone, first of all, to begin with, everyone will be surprised on how do we deal with this, but then things should turn out to be okay. Okay, next topic. DOJ sues Apple, and they talked about 6 things. One is that blocking the super apps, suppressing mobile cloud computing services. I don't know what, you can't do this on your iPhone. Cloud streaming game apps. I'm not a gamer, so I never have tried this. Anyone knows? Anyone have faced the issue where you're trying to stream in a cloud game, you can't do it on iPad? Or sorry, on your iPhone? Cloud streaming games can improve sound accommodation. Blah, blah, blah. Suppressing cloud streaming games harms users. Excluding cross-platform messaging apps. This is like your green message versus blue message. Diminishing the functionality of non-Apple smartwatches. Third-party digital wallet. This is the one which they lost in Europe. So these are the 5 main things. I don't think any one of this is like smoking gun out here. And personally, I don't like DOJ telling Apple what they should include in the product or not.
But actually, Vivek, like if you really watch that video, right, I just shared, it is so much in it actually. They should definitely interrupt this whatever is happening. Maybe as a consumer, like we like the company, but the way they're doing, right, it's a real monopoly if you really see the different aspects of it. Maybe they're controlling whole ecosystem, and that is not a good actually for, like what it's becoming.
So
So,
you can, but there are other ecosystems available.
but it's not interoperable, right? Like, if you are stuck, if you are getting the Apple, if you get into the ecosystem of the Apple, that's it. You are stuck with the Apple, and every product comes with that one. Like
Yeah,
even iWatch, even the cables. Now the cable was kind of forced by Europe. That's the reason they changed it.
yeah.
Otherwise, everything is you're trying to give a reason that's saying that because we want to customize our own way, but that doesn't mean you have to tie to everything with that. So a little bit, at least for environment wise, I see it's a good move actually. Maybe some hiccups we definitely face it, but there at least something, some uh, like some fat will reduce. This is a good way to see that. Some discussion has to happen in this kind of thing.
Yeah, so I think, yeah, I agree. Discussion needs to happen, but I don't like government to saying you should spend, or this is the product feature that you need to worry about.
Yeah, it's not
Government,
just one thing, but I think the multiple things are there. From that aspect, I feel it's a good thing actually. But because some people are kind of not showing the like, because it's a huge company, they're not able to like put a case on them. Now they're all coming to the governor through the government. That was interesting. That's yeah.
Chandra, they should have went after Apple 5 years ago. I
Yeah.
mean, that's what they did it with Microsoft like 20 years ago. And I think this is really bad. This is doing what China's doing. They're distracting from, well, actually China isn't doing it, but Apple, look, I love Apple products, but I only buy Apple products that I can afford. Who? I have a under $100 Lenovo phone. I think this is very futile. It's wasting Apple's time, and especially, I tweeted today that the Attorney General, he has better stuff to do. This is a total waste of time.
so I'm on your camp, Sam, because they started this investigation in 2019. It took them 5 years of lawyers and whatnot to bring a case against Apple. And don't, as a government, we have a better job than to tell Apple what to do. Don't buy Apple. I mean, I only started in Apple ecosystem in 24 first 10 years I was on Android. And then I moved to Apple because my wife wanted iPhone. So okay, I'll also switch to iPhone. And then but my laptop sector is still Windows. I'm not like a full Apple guy, but I love iPhone. It's a good phone. And I'll hate government to dictate whether you should integrate with this messaging app or that messaging app. Let other government, use Android. I mean, you got a Samsung app store, you got a Google app store. There are other app stores available. And
It's
the
not one thing,
reason is
Vivekji. It's not one thing for the phone only, right? There's so much into it actually because that Palki Sharma, yeah, she did really good research and she put everything. There are a lot of good things in it actually because just not on the just phone. Whole ecosystem is kind of a little bit biased to one side. It's a good. It's helping. No doubt. Even I have MacBook. I never restart a computer. I never close down. It's one of the best piece. But that's the way it's getting created. Some discussion has happened. But as like you said, you are 100% right. Like, government should not come. It's
yeah,
a court and maybe the other people that should come and discuss because whatever the super the blocking super apps also not good. The innovation they are doing innovation, but other people kind of you are trying to suppress them. That is not a good thing.
yeah.
So
But I guess, I mean, as an individual, we can't fight. So I think government is coming up as a representative of individual. In that case, yeah, maybe. But yeah, I think one of the reason why Apple has been able to do it so well because they control the whole hardware, right from hardware to software, right? Everything in the chain. Otherwise, it could be like a PC, or wherein the OEMs can build whatever they wanted to bundle. So, but I guess that's where we have to figure out the pros and cons of it. Apple has been able to build it because they're able to control the whole value chain. Other news around Microsoft acquired Inflection AI. They paid $650 million. It's actually not acquired. I don't even know what it is. So it's like an acqui-hire, but not actually acqui-hired because the company still exists. So again, this is how the companies get around doing some of the stuff, because acquisitions is becoming so difficult for these big companies. The FTC is looking at any, they don't want these bigger companies to become bigger and have more control. So like Adobe, they dropped their Figma. Microsoft knew that if they want to acquire, there'll be some antitrust concerns will be there. So what they did, they didn't acquire the company, but they bought out the majority of the 70 employees. They brought them, so which is kind of acquire, but left the company as it is, as a shell company. They also got the license of using their AI models. They bought the license of using their AI model. So technically, they have not acquired the company. They just hired some people, but that the remaining company doesn't have anything. They don't have many people left with them because Microsoft got the co-founders, Mustafa Suleiman, and most of the 70 people. So they did kind of acquire, but without an acquisition, just trying to get around the whole legal definition of, hey, you're not allowed to acquire any more company. Guys, we didn't acquire. We just hired people. Right? So, and again, the other thing was, this is again games played at the boardroom level, is to make the investors whole. So one of the big investors in this company is Reid Hoffman. He also sits on the board of Microsoft. So through this acquisition, because this company really wasn't going anywhere, looks like. It was valued at 4 billion sometime, and it raised 1.3 billion last year. And if Mustafa Suleiman can't make it work, by the way, Mustafa Suleiman was a co-founder or the founder of DeepMind, the first real AI company which Google bought. And then he co-founded this Inflection AI. And what he is told that Inflection had not succeeded in finding an effective business model as a standalone AI company. Right? And so this company was anyway not going anywhere. So Reid Hoffman, maybe, and I don't know. There's no I'm not sensing any conspiracy theory, but he's also a board member on Microsoft. Plus, he is also a co-founder. Might have kind of did a deal in which at least he can get his money back. So it'll make the investors whole. Probably didn't make any money, but at least get whatever you had invested in, get back that money. So that's up on the Microsoft side. So that gives me another. If he can't, Mustafa Suleiman, he can't find a way to make AI work. I don't know about the rest of the other lot of small AI companies that have been raising tons of funds from VCs, from NVIDIAs, from other companies, and generating so much interest in the market. How much can they survive and how long can they survive? And when this eventually come to the real senses of, okay guys, this is a lot of stuff was hype, and the reality and the hype will separate. Some point of a time that will happen. So that's another news I want to talk about. Next one is on Hindenburg, Equinix. There is a huge, it's a huge article. I'm not going to go through all of it, but maybe share some salient points. And this is, as an investor, if you're looking at, investor reports, etc., will help you to understand, some of these terms and how they make a huge difference. So Equinix, like I said, it's a anyone own Equinix here? EQIX. It says a real estate because they convert it to REIT. So this is a company that has got data centers across the world, in America, Europe, Middle East, Asia Pacific, and basically they provide data center services, networking and all that stuff. So obviously, since 2020, there was a lot of demand because everything became online, and now a lot of demand is driven by your AI, the need for AI. So stock has done well, and then Hindenburg drops this bombshell saying, "Hey, they were cooking their books." So, what's their acquisition? What are they accusing Equinix for? Very small thing. We won't even notice. So what Hindenburg is accusing is that it manipulates its accounting for adjusted funds from operations. So when you in any REIT, so like in our normal stocks, we look at net profit. In case of a REITs, you look at funds from operations. Okay. Now, what Equinix started focusing was on adjusted funds from operations. They'll adjust it for, only including the operation capex. So let me just first work through, then I'll explain. So the key profitability metric is adjusted funds from operation, and what Hindenburg is accusing them that it was overstated by 22%. Now the trick that they used was, if you're doing a capex, means if you're investing in your plant machinery, if I'm a data center, I'll be investing in cooling equipment, server racks, cabinets, new building, new flooring, ACs, and all that stuff. All that is counted as your capital investment, capital expenditure, capex. Now, some of that capex could be my maintenance capex, right? Oh gosh, this rack could fall down anytime, so I need to replace the rack. So that becomes my maintenance capex. Some of that capex could be growth capex, which is I need to build these additional capacity because I'm expecting growth in a business. So your capex could be separated into maintenance and the growth capex. What Equinix did was to show all the capex or majority of the capex as a growth capex and not as a maintenance capex. Because what happens if you have your maintenance, it becomes your operating expense. It starts to hit your operating income. But if you're a growth capex, that doesn't come into your operating because it's not a part of your regular operation. It basically you're going to amortize it. So that's where the adjusted funds flow, you only look at your operating or your maintenance capex. You reduce only that. So when they transition to REIT, they start looking at AFFO, and then they suddenly saw a 47% drop in maintenance capex. Why? Because the executives, the CEOs and the execs pay, or the bonuses were tied to how well they are doing in AFFO, the growth of AFFO, which is impacted by a maintenance capex. So again, the same stuff. Show me the incentive and I'll show you the results. Right? If the executive bonuses are driven by the factor which includes maintenance capex, they just made sure that any capex that they do is not a maintenance capex, and everything they started reporting was as a growth capex on their balance sheet. That's what the Hindenburg claims, that they've been doing it for last 10 years. So the shift has fueled the non-GAAP reported AFFO metrics and enriched it top executives. And some of the examples that they gave was like, I mean, you won't think that a company with such a, such a big company, $70 billion market cap, been in business for so long, would do these things. For example, a former director explained how Equinix will seek a new serial number for the refurbished equipment. Right? You get a new serial number, then you say, oh, this is the new stuff I bought. This is not something that we have repaired. And you can book it as your growth CapEx instead of doing a maintenance CapEx. Let me just see. Don't say that I'm replacing a battery in a data center. Say I'm replacing, doing a battery system. When you do a system, it's classified as a growth. I'm looking for a future. Don't say just battery. So they use these different words to sound it like they're doing a CapEx improvements. Again, this one related to bulb. Even some of the light bulb replacements, let's say you change the fluorescent to LED, you are not replacing the light bulbs, you are enhancing. So that's it for growth CapEx. So there are a bunch of stuff you wrote to the report. You'll find how cleverly the claim is that they were doing, these changes. Size of fraud. The overall looks like cumulative $3 billion boost to AFFO since 2015, right? I'll skip all this. And why did they started doing it? Because their regular business was being disrupted by hyperscalers like Amazon, Google, Microsoft, and so it's into two business. One is co-location, the other one is your interconnections. Both of them were being disrupted. And now if you have to, show this AFFO metric, you do financial engineering. That's what they did. And then last week, on March 12th, Equinix announced that the CEO and the president would be transitioning, and then the chairman also will be going out. So both of them, moved out of the company or from any meaningful role from a company. And now whoever is the new CEO will have to face the music. So essentially, that's what happened on Equinix, which was, interesting to see how a company can make use of a small number or a metric and can just boost or change these figures. So it is important to look at what are the incentives. Show me the incentive, I'll show the actions. And that's what exactly happened on Equinix. And this came out, 3 days ago? I haven't seen any press release from Equinix as a response to Hindenburg, these claims. We'll see. But that was an interesting read to go through and see, what games companies play. Chandra says, is there a session? I shall watch the boot camp. Looking forward to Wednesday session. Yeah, Wednesday session, I will put it on the meetup. So, I won't have to individually send it to one, so I'll just add the session on the meetup. So that was on Hindenburg. If you're interested, there's a long report. Hindenburg General does a good job of Hindenburg research. They generally do a very thorough job. So there's a long report out here with a lot more details than what I've told you. So if interested, have some time, spend some time and see how companies do what they do. What else? PayPal. Looks like someone else woke up to is Barron's following us? Well, we did Melee, and then we saw, article in Barron about why Melee is a good company. And now we've been talking about PayPal for what? 6 months? Last September? when did I first talk about PayPal? Last September, yeah, September, October-ish time frame, maybe around that. And been buying the stock. Now Barron, this is the latest, March 18th. Barron came back with an article on it's a time to buy. So anyway, so I think they are a little late, but I guess better late than never. So what Barron has to say, I don't think I couldn't find anything new that they have mentioned, which we didn't talk about it earlier. But couple of points. The company is becoming leaner and meaner. Leaner and more focused. This is talking about those 6, the initiatives which I covered when the new CEO Alex Chris did in January. Fast lanes and some of the other, the product initiatives that he mentioned. So we're seeing a little more innovation coming in. Because the shares are already depressed, it won't take a lot of good news, but just less bad news for shares to start bouncing back. We've already seen share bouncing back over the last week or two. Let me just go back and see where is PayPal. PYPL. Yeah, so it's already hitting around 60. So this was when I think the CEO came and, which was miscategorized as we're going to shock the world. But that's how everyone thought that is going to do it. But all he came and talked about the new improvements in the products. And it's been, since then, it's been done good. Fell down to 56 and now it's been recovering. Now we are seeing some more favorable press coverage on it. I think I started buying it when it was 50 and 55. So looks like the thesis is being validated. Now we have a much bigger analysts or companies talking about the same stuff, which we've been talking about it. Other thing is, management was conservative in guidance. It's in the recent, I think, JP Morgan tech conference, was it CFO? And they were interviewing him, and he was very clear, saying that we want to first put the scores on the board, before we talk about, a bigger numbers. So the guidance that we saw coming from PayPal, and that's where after the earnings paper stock fell down because market didn't like the guidance, that was clearly sandbagged by management, right? So maybe, I'm still hopeful that I think it's still a good buy. I still have a short put at, I think, 60 on PayPal to acquire more. It hasn't yet reached my the overall position size that I want to build for PayPal. So if it goes down to 60, I'll buy more. Otherwise, I'll continue to sell a put. So that's on PayPal. What else? NVIDIA GTC. So we'll come back to NVIDIA. Looks like Reddit IPO. Reddit is back where it was first traded. So generally the market will say that IPO was $34, but you and I, we know that's like that's no one can trade unless you have some friends at a bank, or someone in Reddit that can get stock at your $34. I think Charles Schwab allows you to do that. You can bid for it, and you may get it at $34, but then you have a lockup period and all that. Like I said, I'm not interested. It opened at 47, and now it closed below where it opened. And I still think the 45 is too much for this company. And yeah, this is what I was talking about. If you look into the S1, in addition to the RSU described above, which already he got some $200 million worth of the RSUs, 662,000 RSUs held by our CEO are eligible to vest upon company attaining $5 billion market cap. So I have no doubts that it will be at least above $5 billion, which is where it is. But that doesn't mean that you should go and buy it, because Steve Hoffman, he'll made his money, because he would have gotten these PRSUs at $0. He doesn't care, But if you are investing at $5 billion, what you're looking at is, can it go beyond $5 billion? I'm not keen. So I'll stay out of Reddit. I don't know what your thought is. And then we see the SPAC is back. Yeah, we already talked about it. Okay, so this will be a 4 point. No. Yeah, so we already talked about this one. So I guess only thing pending to cover is NVIDIA GTC, but we got 3 minutes. I want to see any other questions, any other stock you want to talk about. Anything else?
Nike and Tesla.
Tesla has to have a
Rivian also. I don't know why Rivian is going 52 weeks low.
REVN. Oh, so they disappointed during the earnings. Looks like they had earnings recently. Oops, it was down a lot after earnings. 4.4 billion sales, no income. So let's look at Rivian. Let's close this. Let's look at RIVN. $4 billion of revenue. Okay, I'm done here itself. Gross profit is negative. So that's it. I mean, me as an investor, I don't even want to look any further. So they're losing money on every car that they're selling. Just in terms of what's going in the car. So how much money do they have? For how long can they continue to bleed? Cash and cash equivalents, $9 billion.
But Tesla was also like that back in 2012, and then it was negative, and then all of a sudden.
So I don't know. I don't think that Tesla's gross profit was negative. We can look at Tesla, but those were different times. You could raise money at $0, 0%. Now the times have changed. So I'm not even looking at operating. I'm just looking at the gross profit itself is negative. Their overall, how much they are spending. Operating expenses is $3 million. Then you got your cost of revenue is $6 million. So you got a $9 billion, not million, $9 billion worth of expenses. You got $9 billion on your balance sheet, cash and cash equivalents, inventory. Okay, you'll be able to sell it. Total current assets is, say, $12 billion. Yeah, so they will need to, if they don't fix the operation, they'll need to figure out either do another follow-on offering or, raise some debt. They don't have too much money left. Maybe a year worth of it.
Sure. Snap.
Let's look at Tesla. I go back to, this has got 10-year worth of data. They were never negative on a gross profit.
Back in
Operating, I
2000.
understand. I can go back only till 2014.
Okay, that's fine.
Right. So they were never negative on the gross profit. And they were operating in an environment wherein, you could do an offering and you could still raise money, or you can do a debt offering or convertible, convertible notes offering at very low interest rate. Today you can't do that. Right? Today you have to pay 4%. So which is very, very expensive. So we can't, the times have changed.
Okay,
And
I
that's
see.
where these things will matter.
Okay. One last talk, Bumble and Snap. Bumble is the most tempting one. I don't know why. Bumble, BMBL.
Yeah. These are all like 2021 IPO stocks. This is a female oriented dating app.
Yeah.
So revenue, okay. So they've already come down, obviously, because now people want to meet in a real life. So there's no longer that much need to offer dating app. Cost of, okay, so the barely operating income. But good thing is that this year they turned out to be operating income positive. R&D 130, operating expenses 690. I forget net income. Okay, so they barely made some money. It's good. Free cash flow 167. This is little, I would say, that's not entirely correct. If I were to really look at a free cash flow, it's all coming from share-based compensation. So that was a little deceptive because they are paying $104 million as a share-based compensation to the management, which is like 10% of revenue. It's not as bad as like Snap, etc., or as bad as a Reddit. Yeah, but I mean, what's the growth projections for this company?
Like
The revenue
2030.
has been coming. The whole idea was that this is a growth company, and the revenue growth has been slowing down. Like 15%, 16%. That's not a big growth. That's not a mature company. It's right now it's in a stage where it should be growing its revenue.
I see. And
So
one last talk, Snap.
Snap.
Like why it beaten down from $17 to $10?
Glad you didn't ask me why it beaten down from 60 to 10 because this was a $60 stock sometime. So
Those days, those party seasons are gone.
yeah. No, I've been a holder of Snap. I've been holding it for quite some time. So the reason of what the stock has got beaten down is in 2023, not just Snap, but any of the smaller social media companies' lunch was eaten up by these big ones.
I see.
So they didn't grow. Whereas look at a Facebook, Meta grew 25%. Same is the case with Pinterest. So, and number two is, these companies had a difficult time to, obviously these companies were not making money. I mean, Snap never made any money, not even operating income. Look at all its history, they never made any money. And now the growth revenue was eaten by Meta, and that's where it is where it is. And this is one company which, and we used to joke earlier that you can be sure of, there are three things which are real truths in life: death, taxes, and Snap falling after earnings. They always fall after earnings. I think maybe, I don't know about this earnings, but this was like, it'll have a huge big moves.
Yeah, this fall after earning.
This time
40%.
-34%, -5, -14, -17. So there are three things certain in life:
Why
taxes, death, and Snap falling.
Then Lululemon and Nike also falls.
Yeah, Lulu, I think Lulu current quarter was okay. Their guidance was light. So market didn't like the guidance. That's what I know about Lulu. I think the current quarter was fine. It was both top line and bottom line was okay, but the guidance is what market didn't like. I don't own Lulu, and I need to find a space in portfolio for one more ticker.
What was the quote? What was the quote you said for Snap?
I mean, there are three things certain in life: taxes, death, and Snap falling after earnings.
Okay, I see.
That used to be our joke because it always does that. That doesn't mean that you go and short it in the next earnings. Okay, don't do that because who knows? It always had these violent moves. So let's look at Lulu. 2023. Okay, first is that the growth is probably is on a decelerating. It despite the inflation being higher. Looking at from a good 58%, 22% operating margin, good free cash flow margin. But let me look at free cash flow 1.6 billion. How are they? 93 billion, so which is fine. Then it means that's is not being sponsored majority by share-based compensation. A little bit of a capex, nothing much changed.
Last week there was one big news coming for China. Baidu started going into AI and Apple did some partnership with them.
Yeah, I saw the news today, but I didn't. I just looked at the headline. So, do you have a details on what is Apple doing?
Apple devices might use some Baidu or something on device.
It's only in
Something.
China.
It's only in China.
Yeah. Otherwise, they're schmoozing with Google for the AI chatbot in the US.
Yeah, US, I know. So that is only for China.
China. Follow the rules. Actually, Baidu AI, the guy who founded Coursera, he's a Stanford professor from England. He developed the Baidu Labs about a decade ago, AI Labs a decade ago. So I'm surprised that Baidu isn't in front of this. Isn't blowing the water away, but I forgot his name. He's the guy who started Coursera. He's a Stanford professor from UK.
I see.
Who's that guy? No, you're not talking about Andrew.
Yes, I am.
Oh, you're talking about Andrew?
Andrew Ng.
Yeah, Andrew Ng. Did he found Coursera?
Yeah.
Okay, I didn't know about that one.
That's why I know about it. Otherwise, who cares about Andrew
Oh,
Ng?
Andrew Ng, okay. I mean, he's the Stanford professor, right? And he's the foremost authority on AI. But I didn't know that he founded Coursera.
Yeah, that's how I found out about him. And then AI's been around a long time. When I bought my first Google phone back in 2013 or 14, it was oh, excuse me. I thought that was AI. That is AI. It was correcting my spelling and all that. So AI has been here a long time, so it's nothing new. I follow the Google dude that left Google about 15 years ago to start his own ventures. Sorry, not his name, but yeah, that's how I heard about Andrew Ng and AI and all this stuff.
Yeah, Andrew Ng, like I said, he's a big authority on AI.
Last talk for Sophie.
SoFi is retail investors' favorite. I don't have any position in SoFi, but it'll be a little difficult to because this is like a kind of a bank side. I haven't really figured out how to analyze a bank company because I do see a lot of people saying, oh, they increase the deposits. Well, I mean, dude, those are the liabilities for them.
It's like this is not a bank. This is called like a Tesla. like IT bank.
Yeah, this is like a neobank.
Yeah,
So
this is like
yeah, I don't like that they're still not making an operating income, and they've been around for how many years? SoFi has been how old? Shares outstanding has been, oh my gosh, look at how they're diluting their shareholders. From 74 million in 2020 to 945 million in 2023.
So why aren't you worried about Palantir diluting shares?
Palantir actually has to reverse. So if you go back and look at my Palantir thesis, I say big concerns I have on Palantir were two. Number one, that they are heavily government. They need to move into commercial side. Number two, they are heavily diluting their shareholders. And last year, when I said I'm now turning bullish because they've improved upon both of them. It is still operating is still negative. So I think I still have one thing which I'm watching on Palantir is their operating margin still sucks.
Yeah, but it's gone up like 4 times in half
That's
a
okay.
year.
Yeah, I mean, stock can go up based on a lot of other things. If you look at Palantir, the stock-based compensation, if you go to balance sheet, cash flow, stock-based compensation have been reduced. They have started reducing it. So from 1.2 billion to 778 to 564 to 475. So they're improving upon that one. Number two, their percent of commercial revenue has been increasing. So that's why then I told you, you know what? Now I'm becoming bullish because they have improved upon both the things which I'm concerned about. But
so stock dilution is good or no? Not good.
no, as a shareholder, stock dilution is bad for me. It means my stake in the company is being reduced. So let's say there are 100 shares and I own 10 shares. I own 10% of the company, right? That company make $100 in a profit. My profit is $10 because I own 10%. You dilute the stock by 50%. So instead of 100, now there are 150 shares. I only have 10 shares. So now what's my percentage will be 10 divided by 150. 10 divided by 150. 6%. Now you make $100 as a revenue. I only get $6. Earlier I was getting $10. So you diluted me. So it's really bad as a shareholder. So what I don't like in SoFi is they've been diluting their shareholders by a lot. So that's where the outstanding where did we go over there? Outstanding shares have been increased. Either you could, probably must have done some follow-on offering. So the number of shares have increased by a lot.
Check about Nike. Why Nike is not like it was almost like same as Disney all the way to $190, all the way fallen down to $90.
So big
And the
concern
market
of
bad.
Nike is a lot of revenue come from China. And this is I don't even know because I never owned Nike. So I don't know what portion of the revenue come from China, but Nike has good exposure to China. If China is not doing good, China's economy is not doing good, then difficult for Nike to do good.
Also, Michael Jordan's name is diluted.
Yeah, so that may be one reason why, because okay, the conference call will be here because they don't have this was their Q3. Let's see what it says. March 21 is Q3. they show a breakup? No, they don't have many details here. So we'll have to look into their S1 filing to see what's the breakup and how the China revenue is doing. But I guess that's what I'm thinking. So I'm both Nike, Starbucks, as well as Apple, they have a good exposure to China. So that may be one reason. Again, I've not looked at Nike as a company, but let's see if we can pull something out here. NKE. Nike, 9% revenue growth. And net income is actually down. Shares outstanding is all fine. EPS is 3.23. They got a good cash flow is fine. Dividend is okay.
The goal is it has to increase from the year to year. That's all. That's what you mostly check from 20 compared to 2022.
No, it depends. Again, it depends on the stage of the company, right? But Nike is a stage where it's a mature company. So even if it is revenue growth is 9%, it's good enough for Nike. 9% is not at all good enough for Robinhood or for SoFi. But 9% is decent enough for Nike as a business. They're selling shoes, right? They're into sportswear and not in a software. But what could have happened to the stock, and again, I don't follow Nike, is stock price is always a game of expectations and the reality. If the market has built up an expectation of that Nike is going to do X EPS, and then Nike doesn't deliver that, stock is going to get punished. I would rather, if I generally want to focus on not what market is expecting, but what did the management guided to. If management guided, whatever, let's say $51 billion, and if you have been able to do $51.2 billion, I'll be okay with it. But the market was expecting it to do $52 billion, then the stock may fall down. So I don't know what was the analyst expectations, but
it was a weak guidance. They all stock dumped. They were up 10%, and all of a sudden, this all earning manipulation happens. Stock went 9% up, and an earning call, somebody said they need a weak guidance, and the stock went down 7%.
Because I listened to Lulu, and then I know that the current quarter was okay. The guidance was weak. Maybe same is the case with Nike. I didn't listen into the Nike call.
Yeah, everybody is saying the same thing. So maybe there's something smart money keep doing that. They sell the stocks at the top, and then they do have a put for next day.
So yeah, we can't play that game of day-to-day basis. I see Chewy.
Yeah, Chewy also went 10% up and then again 10% down. Weak guidance.
They only had what 10% revenue growth. So the no operating income. So it means that this you probably are focused on a growth rate, and if you focus on a growth rate, then 10% growth doesn't really mean much. So Chewy is a growth company, but it's growing only at 10%. That doesn't justify what its valuation. What's its valuation is? P ratio 184. Price to sales 0.65. Free cash flow 21. Yeah, it's a growth company, doesn't grow only at 10%. And I think the other thing that Chewy has done is they are now moving into veterinary clinics. Any pet parents, or I don't own a pet, but I think I read or heard somewhere they're moving into veterinary clinics, which now completely changed your business, your capital usage in the business, right? So far you were online, e-commerce company. Now if you're moving into, and Chewy was also doing a pet insurance through the partners, but now if you're moving into veterinary business, those are like physical locations, right? that you're not then capital light business anymore. Now you're becoming capital heavy business. I don't know. I mean, I don't own Chewy, so I didn't look into it. But now you are changing the capital structure of your business. How will that perform? Don't know. So that's a new spin into Chewy business. So if you're an investor in Chewy, don't think that is going to be a capital light. Now they're going to have a vet clinics. If it turned out to be great, fine. But there's some new uncertainty in their business model. So be aware of that. I see another one, Lucid. Wait, why is this company still around? Fisker was like almost filed for bankruptcy. Yeah, I have nothing to say on Lucid. Like $595 million revenue, and they've been in negative $1.3 billion gross profit. Like just blowing the money. Just rather yeah, I don't know. I have no thoughts on Lucid. I never touched this company. Never bought any shares. Oh, wow. At some point it was in the height of frenzy, sort of $50. I'm okay. I'm not worried about that. The 50 has become whatever, $2. The question is, are they improving their business? Are they improving their operations? Are they becoming more profitable or losing less? So, which I don't find it here. So yeah, I'll stay away from Lucid. And you is one company that I have on my radar. Is once I get rid of StoneCo, probably I'll invest in this one because I heard a lot of good things about NU. And I did a IPO when they came IPO way back. We did a review. Did I do an IPO review or maybe? I think I just Nubank, because I recall talking about Nubank in one of these sessions. Yeah, so when was this document created? 2021. Yeah, so I did go through Nubank way back in 2021. So I think since then the business has done better. So let's look at their numbers. Yeah, now this is a growth company, though it has slowed down, but still 67% growth is a good growth. Then I can characterize this as a growth company. It's growing at 67%. Okay, gross profits, operating income positive. Now they have turned the corner in 2023 from being operating income negative to operating income positive. Right. So yeah. Share outstanding. So a lot of dilution in 2021 to 2022. What did they do? A follow-on offering? New share offerings. Yeah, they did another one 2021. That's where they filed for 2021. So that's why we see huge dilution. Let's look at balance sheet. $5 billion on their balance sheet. They got a goodwill. So what did they acquire? Maybe they acquired some companies. How much debt? Not too much of a debt, which is good. So balance sheet is fine. Share-based compensation is 212. What is free cash flow? Okay, so even if I account for share-based compensations, still they are cash flow positive. Yeah, so I think this is a good company to keep on radar. Again, I'm not going to invest in based on this 5 minutes or 2 minutes analysis, but this is a company that, yeah, something that is in investable universe. Now you can dig deeper to see how they are growing. What I heard is they've been growing their users really quite rapidly. Probably they'll have like more than 20 million or more than what Bank of America has like online users. So I heard some good things about Nubank. And now looking at the numbers, they look fine. I mean, there are some companies which I look at the number and I'm not even interested in it. Like Lucid was one of them. Right now, SoFi is one of them. But Nubank, no, I think there's no outright rejection for Nubank. Charter Communications. Charter, these all were a very stable dividend. I don't know whether they pay good dividend, but it's like a very stable company. Yeah, you can't expect much growth on this on the business. It's a pretty stable company. It's in, I think, is this the company that has got those towers? No, that's AMT, American Towers. The Charter and American Towers, this is the company which is generally talked about. You want to invest in a stable company, giving good dividend, not going to go out of business, but not going to grow at like 20%. This is one of those companies. So, but don't expect it to, double your money. How doing on the stock side?
Hum.
Sorry, which one?
HUM, Hum. Hum and IWM index.
HUM, what is that? Oh, Humana. Yeah, so Humana, I remember, in fact, Humana used to be one of my customers. I think, and again, I've never owned this company, but they are in providing, they do a big, they serve a big chunk of their customers are those Medicare, those customers. And what I got to know in the recent one, why the Humana was down is because of, those Medicare, the payments, etc. I mean, that was not up to what they were expecting, something related to that. But so that's why I saw that net income has been going down. 14% growth year over year. Okay, operating income, what's your EPS? You're paying $20 EPS, free cash flow, $3 billion. What's a free cash flow yield? Margin is 3%. EBITDA margin, let's look at the free cash flow yield. Free cash flow per share is $25. And the stock is at 348. So 7% yield is good yield. Not bad. Yeah, but again, I don't understand, this insurance space. So looking at just the numbers, the company seems to be okay. But you need to be aware of this whole, how the Medicare stuff works. And because you run the risk of, because that's like controlled by government, the government changes, what happens to that? And suddenly you find, a new president who's like, okay, I'm going to rein in all these expenses. So that's one concern that you will have in this. It's heavily dependent on those policies. I personally won't touch it because they don't control, there are a lot of things which are outside their control.
One good thing I want to understand with you is like, so instead of going to any stock, why can't you just pick a whole index like IWM index?
Sure. That's why my biggest position is SPY.
Oh, I see. So you mostly, rather than trading in stocks, you mostly pure put money in index?
No. I said my biggest position is SPY, which is 12%.
I see.
So I'm gonna share my portfolio at the end of a month. I do it after every end of a month. So you will see what my top 15 positions are
Yes.
after end of
Can
a
you
month.
compare IWM? Because like mostly triple Q and SPY is already up so much.
So
And
so IWM is the ETF for Russell 2000, which is small and medium business segments, and which generally don't do good if interest rates are higher. So that's why IWM has been depressed. And if interest rates gonna decrease, IWM should do good. Tom Lee, and again, don't quote me, it's Tom Lee says that he still sees IWM to go up 50%.
yeah, I read that last week somewhere that this can go to 50, 300.
Yeah, so that's what Tom Lee says, because and if interest rates are cut, they'll, like I said earlier, that'll be good for small and medium businesses who generally have to take loans, and then they'll be able to refinance it at a cheaper rate. All right, guys, we gotta go out for lunch. So it's 12:32. I gotta go out now.
Thanks
Sorry
a
if
lot.
I've not covered some
Really
stocks.
appreciate it.
Probably cover later. Okay, all right, bye-bye.
Thank you so much.
Thank you.